You are frozen by a dozen contradictory indicators, a cacophony of signals where one screams buy and another sell. This is the paralysis of analysis. The professional trader cuts through this noise not by adding more tools, but by synthesizing a coherent story from three core components. First, identify the market structure, the dominant trend on the higher time frame. This is your strategic map. Is the market an uptrend, a downtrend, or a trading range? Your mission is to align with the path of least resistance, not fight it. In an uptrend, you seek only to buy. In a downtrend, only to sell. A trading range demands patience, for it is a coiled spring building energy for its next decisive move. Second, determine your tactical location. In an uptrend, you do not chase price. You wait for it to pull back to a logical area of support, a historical level where buying pressure has previously emerged. This is where you wait with patience for the market to come to you. Third, and only after structure and location align, you wait for the trigger, the confirmation. This is the market's proof that demand has returned at your support level. It might be a spring, a false breakdown below support that swiftly reverses on high volume. This precise signal is your green light. Synthesis is everything. A stock in an uptrend pulls back to key support. It then forms a spring, violating support briefly before roaring back to close above it on high volume. Only then do you act. You enter above the spring's high, placing a stop, lost just below its low. This disciplined framework separates the hopeful amateur from the consistent professional. To internalize it, return to the foundational wisdom in the annotated edition of Richard Wyckoff's How I Trade and Invest in Stocks and Bonds, which preserves the timeless principles of trading as a serious business governed by the market's own action. This approach to trading isn't just about finding good trades, it's about building a mental fortress. That fortress protects you from the two most destructive emotions in the market, greed and desperation. The first enemy is greed, disguised as FOMO. You watch a chart skyrocket, and every instinct screams to buy now. The framework silences that noise. You run the checklist, structure, an uptrend, yes, location, miles above any solid support. It's stretched thin. The conclusion is immediate. This is not a high probability entry. You let it fly by. The professional's edge isn't in catching every move, but in knowing that protecting your capital from low-odds bets is what compounds over time. Opportunities, like trains, run on a schedule. There's always another one coming. The second enemy is desperation, the urge to catch a falling knife. A stock crumbles day after day, looking cheap. The rookie thinks it's a bargain. The strategic trader consults the framework, structure. A powerful downtrend. The path of least resistance is undeniably down. Buying here is fighting gravity. They won't even glance at a buy order until the market itself shows a change of character, a consolidation, a sign of real accumulation, proof that the selling pressure is exhausted. The framework is a filter, straining out reckless, emotion-driven impulses. To truly lock this in, let's flip the script. Suppose the structure is a firm downtrend. Our objective shifts. Find a high probability spot to enter a short sale. We pinpoint our location, a key resistance level, often a former support floor that has cracked. Markets have a memory. Price often rallies back to kiss that broken support from underneath before resuming its fall. This is our zone. We wait. The amateur, holding a losing long position, sees that rally as salvation. The strategist sees a setup. Price taps our resistance. Now we need a trigger, a sign of failure. Look for an upthrust. An upthrust is a trap. Price jabs briefly above resistance, baiting breakout buyers and flushing out nervous shorts. Then it reverses sharply, collapsing to close below the level on high volume. This is the fingerprint of distribution, the smart money, using the rally's excitement to unload their shares. It's not hope, it's a gift, offering a high odds entry in the direction of the core trend. This upthrust is our trigger. We have the structure downtrend, the location, key resistance, and the trigger, the failed breakout on high volume. We can now initiate a short position with a protective stop loss placed just above the high of the upthrust. If that high is broken, our thesis is wrong and we exit with a small managed loss. Now let's address the inevitable question. What happens when it doesn't work? You follow the process perfectly, you identify a clear uptrend, you wait for a pullback to a perfect support level. You see a textbook spring confirmation, you enter the trade with a clearly defined stop, loss, and then the market reverses, hits your stop, and you take a loss. The amateur reaction is frustration and doubt. The system is broken. The market is rigged. The professional reaction is one of indifference. They understand that no strategy is 100% accurate. Losses are a part of the business, a cost of operation like a store owner accounting for unsold inventory. A well-synthesized strategy has risk management baked into its very core. The stop loss is not an afterthought. It is part of the initial plan. The professional knows their win rate might only be 50% or 60%, but their winning trades are on average significantly larger than their losing trades. This is called positive expectancy. They might lose 1 unit of risk on a failed trade, but they aim to make 2, 3, or even 4 units of risk on a successful one. Over a large series of trades, this edge ensures profitability. Therefore, when a trade fails, the professional does not question the entire strategy. They accept the loss, document the trade in their journal, and wait for the next high probability setup to appear. They know that their profitability comes not from any single trade, but from the consistent application of their edge over time. It is a statistical game, not a game of perfect prediction. The beauty of strategy synthesis is its adaptability. It is not a rigid black box system. It is a logical framework that helps you interpret the market's narrative. The specific triggers might vary. Sometimes it will be a spring. Other times it might be the absorption of supply at a key level where you see the price refuse to go down despite heavy selling pressure. Or it could be a simple sign of strength, a powerful upward bar on high volume that breaks a key resistance level signaling the start of a new markup phase. The principles remain the same. Align your trade with the dominant trend. Enter at a logical location and wait for the market to show its hand before you commit. This method forces you to become an active thinking participant rather than a passive follower of signals. It trains you to ask the right questions. Instead of "what is this indicator telling me?" you start asking, "what are the large operators trying to achieve here? Where is the evidence of their activity?" You begin to see the chart not as a series of random wiggles, but as a strategic battleground. The trading ranges are the periods of preparation where armies are being amassed. The trends are the campaigns, the major advances and retreats. The springs and upthrusts are the tactical feints and skirmishes designed to mislead the opposition. By synthesizing the core elements of market action, you move from being a foot soldier reacting to the chaos of the front lines to being the general, observing the entire battlefield from a high vantage point and making decisions based on a complete strategic picture. Let's conclude by solidifying this into a mental checklist, a brief, light routine you perform before every single trade. 1. What is the dominant structure on the weekly and daily charts? Am I aligned with the path of least resistance? 2. Have I identified a key historically significant support or resistance level that serves as my location? Am I waiting for the price to come to my level or am I chasing it? 3. Is there a clear, unambiguous confirmation signal? Have I seen evidence of institutional sponsorship in the form of price and volume action that validates my thesis? 4. Do I have a predefined entry point, a predefined stop, loss that invalidates my idea, and a logical target for the trade? Do I know exactly how much of my account I am willing to risk on this single idea? If you cannot answer all 4 of these questions with absolute clarity, you do not have a trade. You have a gamble. You must step away from the screen and wait. The market offers a near infinite number of opportunities. Your capital, however, is finite. The purpose of a synthesized strategy is to protect that finite capital by deploying it only in those rare moments when the evidence is overwhelmingly in your favor. It is the practice of professional patience. The journey to becoming a consistently successful trader is not about finding a secret indicator or a magic formula. It is about building a robust logical framework for decision. It is about understanding the timeless principles of supply and demand, of human psychology, and of risk management. It is about taking these distinct concepts and weaving them together into a single coherent strategy that fits your personality and your time frame. The market speaks a clear language. The work is not in predicting the future, but in learning to listen to the present. If you wish to become fluent in this language, the journey of learning and observation must be a continuous